How about this? How well you adapt. That includes all of the following. How well you adapt to trends and how consumers select businesses, like through ads in phone books or newspapers, compared to selecting businesses through rankings and reviews online. Another factor as far as how well you adapt could be how well you adapt to trends specific to your industry, like technological change, innovative products, or even franchising with a leading brand. As well as how you adapt to global trends, like global fuel prices. For many businesses, that has been a major factor. In 1999, when global oil prices doubled in less than 12 months, the stock prices of airlines within the U.S. fell 40% in less than 12 months. Could it be that airlines were not budgeted for a doubling of fuel prices and experienced some challenges financially that was reflected in investors selling those companies, resulting in a 40% decline in the share values of those companies? How about how well you adapt to national trends, like changes in national political regulations? Certainly, those can change over time, again, sometimes suddenly. And how about how well you adapt to local trends, like rates of population growth or population decline? It does happen. Now, if you want assisting adapting, then you want to work with someone who's attentive to which trends will be the most influential in the future, in general, and specific to your business, specific to your industry, as well as your particular business and your company. Now, that'll take some exploration of the details of your specific industry and your specific business, but we can give a few examples of trend analysis and compare the possible value of a few different points of reference from some of the large-scale trends and how well people can adapt to large-scale trends. Well, we're going to look back to 2005 and the commentary of an analyst that you might not have read in 2005, and you might have read some similar analysis to this particular individual's analysis, but I'm actually going to read you their analysis, and I'm going to put an image so you can read the actual image from their publication. And this is from James Paulson, a PhD in economics. He's the chief investment strategist for Wells Capital Management. That's the investment branch of Wells Fargo Bank, which is a bank that's prominent within the western states of the United States, not so well known on the East Coast, but it is a pretty big bank within the U.S., and I think you're going to find that a lot of the comments that Mr. Paulson, Dr. Paulson, made were similar to a lot of the things that were presented in the mainstream media and other investment advisory publications besides this publication from Wells Capital Management. The headline is, "Stay away from the flurry of worries." When most seem bogged down worrying about when the housing bubble is going to burst or when oil prices are going to cause the consumer to capitulate, investors should be focusing away from such issues toward the many positive things happening and yet to occur. The global economic recovery currently seems healthy, and we believe is far more sustainable than widely perceived. Earnings growth is chronically producing positive surprises. Inflation and interest rates continue to remain amazingly low in a world with solid real growth. The consumer shows more strength now than any time in the recovery, by which he meant everything from the October 2002 low. And the consumer will not likely fail until after mortgage yields have been higher for a period. U.S. businesses are sitting on a powder keg of liquid buying power. In other words, cash. Growth in Europe may just now be starting to accelerate, and perhaps the U.S. trade deficit is finally starting to turn positive. I'm going to stop reading at that point. I want to highlight a couple things that he said. The first thing is the housing bubble. Don't worry about a bursting of the housing bubble. The next thing he mentions is oil prices. When are oil prices going to affect consumer behavior? Don't worry, says Dr. Paulson. Don't worry about oil prices. Investors should be focusing away from such issues toward the many positive things yet to occur that aren't happening yet. That's actually what he wrote. He also said towards the many positive things happening, but even focus on positive things yet to occur, that's just kind of a weird thing to say to me, in my opinion. He also made that reference to consumers failing. He says consumers will not likely fail until after mortgage yields have been higher for a period. Fail? He's talking about consumers failing and not being likely until after mortgage yields or mortgage rates, interest rates have been higher for a period. Okay, so well, it's not a very favorable long-term forecast that he seems to be giving there, but anyway, that was in September of 2005. Now, by September of 2005, I had already noticed a peaking of real estate markets in Phoenix and Las Vegas, as well as a peaking of the U.S. housing market index, the HGX, the stock market index for the U.S. housing sector. Why was I looking at Phoenix and Las Vegas and any other real estate markets? Those, are, of course, are the sprawling desert metros that had such tremendous booms in the prior years and even the prior decades, up to 2005 when they peaked and fell quickly and far, earlier than anywhere else in the U.S. and further than anywhere else in the U.S. so far. Well, why was I looking? Because I had expected a decline in real estate within the U.S. and elsewhere. I'd noticed the decline in Japan since 1989. And in 2004, I made specific reference to fuel prices, gasoline prices. One of the things that Dr. Paulson kind of dismisses and disregards. He specifically mentions it and disregards it, dismisses it. Here's what I said in 2004. This was in a publication called The Real U.S. Deficit, Oil. On November 7th, 2004, I wrote an article and asked this question. How many dollars will it cost to buy a gallon of gasoline next year? That would be November of 2005. Now, gasoline prices in the U.S. went up from around $2 to over $3 in 2005, and then to over $4 in 2008, and now in 2012 they're back up approaching close to the highs of 2008. In that article, which was called The Real U.S. Deficit, Oil, I made use of the term the domino effect. If you go to the website thedominoeffect.com, you can see a few details and a few screenshots from that article published in 2004. So I have asserted that not only did fuel prices contribute to the decline in the U.S. airline sector of stocks back in 1999, starting in 1999, but it also contributed to the bankruptcy of U.S. Air. And from 1999 to 2008, oil prices went up globally over 1,200%. Not nearly as much as the 1,600% rise of a certain stock sector in the U.S. stock market from 2000 to 2010, but a pretty large rise, much larger than any other major commodity. In fact, there really is no commodity as significant as oil, which of course is the substance from which gasoline is derived. So let's look at an article even prior to 2004. I'll make a quick note that in the 2004 article, which you can review yourself, I made reference to the global credit crisis, fuel prices rising so high that it would affect consumer behavior, that it would affect businesses, that it would interrupt the economy of the U.S. and Europe, just as it had done to Japan previously. But let's look a little further back to March 3rd, 2003. This is a paragraph that I like to quote from my very first publication relating to investment markets on March 3rd, 2003. Yes, we can profit from the collapse of the credit bubble and the subsequent stock market divestment. However, real estate has not yet joined in a decline of prices fed by selling and foreclosing. Unless you have a very specific reason to believe that real estate will outperform all other investments for several years, you may deem this prime time to liquidate investment property for use in more lucrative markets. End quote. So what did I mention there in early 2003? There's a collapsing credit bubble, a credit crisis. It's already evident to me as of 2003. It had started in Japan in, let's say, 1989. That's when their stock market peaked and the decline began. In 1999, the stock market of the UK, of Great Britain, it peaked and began to decline. There were big downturns in various stock indices within the U.S. in 1999 and the year 2000. There was a stock market divestment. What I mean by that is people selling stocks, producing a dropping of prices, such as the 46% decline from 2000 to 2002 in the U.S. S&P 500 stock index. What I also wrote there in 2003 is real estate has not yet joined in a decline of prices fed by selling and foreclosing. In other words, clearly, I'm anticipating a decline in real estate. Again, early 2003, I'm anticipating an eventual decline in real estate caused by a collapse of the credit bubble, caused by a credit crisis. What does that mean, a credit crisis? It means less lending and borrowing. If you read the rest of the article, you'll see that that is what I'm referring to. When there's less lending and less borrowing for real estate or anything else, that's going to affect the total number of transactions, the total the sale prices for transactions. And in the case of real estate, you have a market extremely sensitive to lending trends. So a huge proportion of real estate purchases are funded by financing, by borrowing. So when I'm looking in 2003 at a decline in lending and borrowing worldwide, in particular US and Europe, I'm suggesting that one of the markets that will be most affected by that will be real estate. And no, real estate has not yet joined in a decline of prices fed by selling and foreclosing, but that's what I'm talking about. Even in early 2003, yes, a wave of foreclosing, kind of like we saw a few years later, and are still seeing to a certain extent. I close that paragraph by saying, unless you have a very specific reason to believe that real estate will outperform all other investments for several years, you may deem this prime time to liquidate investment property, to sell out, to cash out for use in more lucrative markets. In other words, the risk in real estate was rising tremendously, and the opportunity was declining. And in that same article, I point to a stock sector that went up 250% in the 18 months from late 2000 to mid 2002. And I'm saying there are other things more lucrative than real estate, which with much more opportunity and much less risk. By 2010, that sector of 15 stocks was up 1,600%. From a low near 35 in late 2000 to over 600, just barely over 600 in 2010.